be. And of course, WPI, again, the central bank sees it in the rear view mirror, in the sense that keep an eye on WPI, but CPI is still the main indicator, which is due later today. If a sharp fallback below 8%, I think would be a heartening sign there as well. But again, base effects everywhere, so we need to watch the sequential trends.
Sajid, both Radhika as well as Sangeeta seem to suggest that it will take at least 6 months to a year before we get inflation under control. Now, is that too long a period for a country like ours? Because you have so many people, below poverty line, so many people living on the edge, as it were. So can the government do anything dramatic, within a shorter period so that people don't get impatient?
I think we have to realize here, Metli, that we've had high food inflation for the last decade. Food inflation over the last 10 years has averaged 10.3%. So I think we have to all brace ourselves for the fact that this problem, if it was solvable in 2 or 3 or 4 quarters, would not persist for a decade. I think that's the first point, that this is going to be a multi-quarter, multi-year fight. There are other ways to bring inflation down, which is to tighten fiscal and monetary policy even more aggressively. But remember, there are costs to growth from that, and given the fragility of India's growth scenario and the fact that we've had sub 5% growth complicates macroeconomic management. I think the one area where there's no trade-off is really on the food front, that if the new government can use its political capital, especially with states, because a lot of the issues here fall under the domain of the states, not so much the center, to do some of these reforms that we've been talking about for the last 5 years, which is, try and find alternative supply chains for perishables, fruits and vegetables, reduce MSP's growth, and that has happened for the last 2 years. Use your buffer stocks of rice and wheat more aggressively. Have a common market, of common food market for India. Those are clearly win-win situations because they are not growth inhibiting. At the same time, they bring food inflation down. But there's a structural dimension here which will take several quarters. But I think for today, let's celebrate the fact that from the 2 data points you've mentioned, food inflation has moderated on a seasonally adjusted basis. The headline number seems to have grown by only 20 basis points, 0.2% month on month. And the food number, from what you mentioned, 8.1%, even though the headline is down, on a sequential basis is actually grown by 1.2%. So it's still pretty stubborn. What this tells me is the non-food components have come down. I'll wait to see what the manufacturing breakdown is, but prima facie, if the manufacturing number is 3.6, it suggests, at least till we have more details, that the core number month on month has not jumped too much, unlike last month. So at least prima facie, this is a good data point. I think let's enjoy that for the moment and worry about the larger issue in a bit.
Ajay, would you concur with that? Because you had 2 pieces of good news over the weekend. We first saw the IIP do much, much better, and we've seen now the WPI also come in substantially lower than what everybody is expecting. So does this mean that we're out of the woods? Because particularly IIP is the 2nd consecutive month, and manufacturing particularly has started looking up.
So yes and no, we're not out of the woods, but yes, I mean, clearly there are reasons to feel good about. I think the important thing is that the budget also spells, at least from a primary articles perspective, that, as far as prices for the last mile, I'm not talking about food products, but other consumable products should come down to some extent. And I think that will give a positive kicker to inflation. In addition to that, you really have to wait and watch for the monsoon. This was a period of extremely high food inflation last year. We just hope that if the monsoon revives now, we don't have a repeat of that. And then, of course, these numbers will continue to look better. I think it's very early days, but yes, I agree with Sajid. It's a good starting point, and we really like these numbers for now.
Sangeeta, before we got the WPI numbers, Dr. Joshi was speaking about how the fiscal deficit for the year might go up. In fact, they can think it will go up to about 4.5%. Now, how much will that really kind of play spoil sport as far as RBI's tightening policy is concerned? Will it have to over-tight because of the looseness of the fisc?
I think the RBI has been playing a balancing role, and what's on the whole heartening is that if we leave that 4.5% number aside, but just look at the other commentary in the budget, then it's clearly towards reducing the fiscal deficit, which means that there is the fisc and the monetary policy can then move in tandem, and if the fisc gets tightened over, let's say not this year but next year, that leaves a room for monetary policy to become supportive of growth. So I think we need to look at it in a slightly longer time frame. And my own sense is that, we'll have to wait a reasonable amount of time before we see a cut in interest rates, both for, a structural shift downwards in inflation and for us to feel comfortable that, it is not a month-on-month or a base effect scenario, but really we have brought it down to reasonable levels. And the second thing is to allow for some level of slippages, which could well happen in the fisc as far as, the current year is concerned.
Radhika, the government, as far as agriculture is concerned, seems to have very much of a knee-jerk kind of policy. One day they ban the export, one day they raise the export price, the minimum export price. Do you think there's any hope at all, or what people have been arguing for a long time, a big bang reform in agriculture, like what we saw in industry in 1991, where you free up input prices, free up output prices, and let markets decide the price, and then support those who are below that poverty line, give them through cash transfers or some other means, but basically free up the agriculture sector completely?
At the onset, I would like to say, of course, the markets were expecting big bang expectations soon after the new government took hold. But if you've seen their policy agenda, it has been more gradual, more calibrated. So I don't think even for any specific sector, even if you take agriculture, that it's going to be something so big all at once. I think the way forward for them is to do it more slowly. Like Sajid pointed out, food inflation in particular has been rampant for past decade. So to get any kind of reform into place, I think big bang might not help. But to be selective, to free up the market specifically, because the center is one part and the states are another. So basically there has to be more communication with the state governments to make sure that the problems on the ground, especially for the agricultural sector, take place. So of course, in something like the wholesalers, if you want to bring a national market in place, then you have to make sure that the farmers are able to reach the retail sector more easily. So there are many levels of reforms that need to be taken. So it's very difficult to open it up all at once because there are going to be other factors, wholesalers as well as some traders who will there's some trade-off, essentially. So we need to take all of them into view before doing anything that is very open all at once. So going forward, I think the government was right in addressing at the budget particularly the entire value chain. We're talking about rural credit, talking about warehousing facility, logistical constraints, easing those constraints. So it's a good measure to start with, but it's not some of the measures are not exactly budget oriented. So we have to see the reform agenda as beyond the budget. So I think in the quarters to come, the government will roll out these measures on a gradual pace and make sure that the agricultural sector is free of all the constraints that is in place now. But of course, the immediate risk for rural incomes as well as the agriculture production is the weak monsoon. So I think that is one big mountain to climb before getting on to the reforms on a grander scale.
Mr. Joshi, so far we've been focusing on food inflation and talking about what the monsoons could mean for food inflation. But there's another aspect of inflation, of fuel inflation, which we've really not addressed in the recent discussions. But given the fact that even though oil prices have come down globally, they have softened, that's always a big uncertain number. So were you a little surprised that the budget didn't talk about a faster process of deregulating oil prices, particularly in the case of diesel? 50 paisa per month is way too low.
Well, I think as was being mentioned, I think it's better to follow a gradual approach as far as the subsidies are concerned, because you saw the kind of noise that was created after the rail fares were hiked, particularly for Mumbai. I think they had to retract. So it's better to go gradual but be firm, and I think go in the right direction. It may be less, but I think you can't do much about it. And but I would see some measures now. I would expect some measures at least to correct the anomaly in kerosene and also LPG going ahead. So if you add them all together, I think they would add up to a step in the right direction. If that doesn't happen, I think then the leeway, the financial leeway with the government will remain very low, and their ability to shift spending from revenue spending towards capital spending will be restricted. Other thing I wanted to point out was that we were focusing on the fiscal deficit number, and looks like 4.5 to us is a more feasible or a reasonable number. But I think it's not that government can't attain 4.1, but they'll have to do exactly what the previous two budgets had done. Both had very aggressive revenue targets which could not be met, and then government government started cutting the capital spending to meet the fiscal deficit target. If you want to attain 4.1 this year, I think you might have to resort to cutting spending on many of those schemes, etc., whatever you have announced. I think that would not be right for growth in the economy, both from the short term as well as from the medium term perspective. So I think my sense is fiscal deficit at 4.5 would be the right number to go by, and I think markets are also expecting some slightly higher number. But 4.1 is going to be an issue, and I don't know how RBI is. I don't see it as a major slippage. I mean, from 4.1 to 4.5, as long as the direction is right, and if they bring in the GST also, then you are more convinced that the medium-term trajectory of public finances would be as budgeted, and you will see both a kick to growth as well as revenues from the GST. If that doesn't happen, then I think even the medium-term trajectory becomes a bit difficult to achieve.
Sajid, can I ask you to do some crystal ball gazing and ask whether you would concur with Mr. Joshi that the only way the government can achieve that 4.1 is by again crunching capital expenditure, the much needed capital expenditure, and that's the only way they can do it unless things change very dramatically. Would you agree with that?
Well, I do believe it will be challenging, but that's exactly what the previous finance minister did in the last 2 years. But I think there are a couple of other options here. We actually have very buoyant capital markets, and one other way to get to 4.1 on the surface is through higher asset sales. So if you push up your disinvestment program, if you have a more spectrum sales, for example, that's a way of raising non-tax revenue that would optically bring you closer to 4.1. But remember, from the standpoint of how much fiscal stimulus you are injecting or taking out of the economy, you've got to take asset sales out of the equation, because unlike taxes and duties, they are not contractionary. They have to be below the line in most countries. It's only in India that asset sales actually count not towards financing a deficit but computing a deficit. So asset sales in theory is one way, though it won't change the underlying fiscal stance. But yes, I agree with DK that the other option is to cut expenditures. But we have to make a trade-off here, right? If you don't do that, then you have a wider fiscal stance, you have higher aggregate demand, and higher aggregate demand, all else things being equal, will put more pressure on core inflation. So I think this just goes back to the fact that to undertake more credible and sustainable fiscal consolidation over the next few years, you need genuine fiscal reform. We need fiscal reform on the tax front, through a goods and services tax, through more base broadening, and you need fiscal reform on the expenditure front, on the subsidies front. For example, by using UID or Aadhaar to target subsidies more effectively. So I think without those more fundamental reforms, we're always going to be in this situation every year where either you're forced to raise taxes, which is unpopular given that growth is weak, or you're cutting back on the discretionary component of expenditure, which typically is capital formation.
Sangeeta, which of these policy options that Sajid just outlined, GST, expenditure reform, because the government has appointed an expenditure management commission, but this is not the first expenditure management commission we've had. In 2000, 2001, we had a similar commission, and the government never bothered about its recommendations. So which of these do you think is more likely to happen, the GST or expenditure reform?
I think GST will definitely happen. I mean, that's clearly on the card. So it's really a question of when, and I think by next year we should see more specific announcements on that. And as far as the expenditure control is concerned, I think we're at a stage now where we really don't have a choice. So if you want to, direct subsidies towards food, and the food security bill is looming, and that's something that for political reasons no government will really want to backtrack on, at least officially, then that's going to be a huge expenditure looming up. So you really do need to be very careful about where you're spending the money, and you need to prune down on various other subsidies which are there in the system. So I think typically what we've seen in India is that action tends to happen when you're pushed against the wall and you don't have a choice. And I think we're pretty much at that juncture now, which is in some ways the silver lining to the cloud that we've been living through in the last 4 or 5 years.
Okay, on that note, we'd like to take time out to thank all of our experts for being with us and assessing the inflation numbers in greater detail. Thanks so much for joining in. And of course, that's the general consensus that we're getting. Yes, a 5.43% number is certainly a positive, but yet credible steps towards fiscal consolidation and fiscal reform need to be taken. Targeting subsidies also remains the order of the day, and watching out on how the monsoon pans out will be a crucial factor. 74.43 on the Nifty. The Sensex is laying low, off by 0.2%. The rupee marginally appreciated but is back at that 60 mark, and the Bank Nifty futures holding up in the green, pretty much status quo for the bond yields at 8.7%. But on that note, we'll slip into a quick break, come right back with lots more on Market Sense.